Now, where the cost can come from is as you enter those slow go or no go years. And these are the kind of costs that I think people really get concerned about when they're thinking about total healthcare costs in retirement. So, Stefan, you found this graph for us. Tell us a little bit about just, what you're seeing here in terms of costs and, really what's the difference between medical care and long-term care?
Yeah, Dana, and just in general, this chart is pulled from one of the insurance companies, and they talk about what the local cost of care is, and we can specify by someone's individual area, but just in overall across the U.S., you can see that based on the different levels of care that somebody may be receiving for care needs, you can see it goes kind of up the food chain from receiving care in your home, starting in 2024 dollars, from anywhere from around $6,000 per month, and then different facilities such as adult daycare at $2,000 a month, an assisted living facility at $5,500 a month, and then when you're getting up to a little bit more of a care in a side of a nursing home, you're looking anywhere from $8,000 to $10,000 a month, and these are all U.S. national averages. Depending on where you're located, right? This can change. I'm located up in the Northeast, where there is a higher cost of care for these services being provided. But once again, I think the whole overarching theme of this is, these are not small numbers that we're talking about here. So depending on what potentially can transpire later in life, you want to make sure that you have a plan in place for how to address these potential large numbers that may come your way. And the one thing you did ask about, right? And we did touch about this on this earlier. Medical care versus long-term care. Right? Medical care is going to cover injuries and illness and the treatment that's needed right after that. If there's any care or rehab that's needed as a result of those injuries or illness, typically that's not going to be covered by health insurance or very limited. So long-term care comes in as saying when you need help, when you need assistance, when you need help for you to go about your daily activities and live your life to, how do you pay for that? And that's where long-term care comes in.
Yeah, I've heard it called the 6 activities of daily living. I don't have the list in front of me, but it was things like cooking and bathing and do you remember what else is on that list?
Yeah. So I can kind of run down that list right now. So it's eating, dressing, bathing, continence, transferring, and eating, right? So those are the 6 activities of daily living. So typically, if you cannot perform 2 out of 6 activities of daily living, if you have an insurance-based solution, then you would be eligible to receive benefits. The other triggering event is also a cognitive disorder. And it's not just merely that you're forgetful or things like that. It's, a cognitive disorder, and then you're under a plan of care from a doctor that you need supervision. So that would be something like you may wander out into the street. You may take too much medication. You could leave the stove on. Right, something where you're a danger, and then to yourself potentially or others, and that you need that care. My little joke on this is that on a daily basis, my wife likes to tell me I qualify for long-term care, but I say that's her opinion. I have plenty of friends out there that think differently, but it's a nice debate that we have in our household on certain days.
It's interesting you mentioned leave the stove on. My grandpa on my mom's side has since passed, but he, was in a care facility, a nursing home care facility for cognitive reasons for many years. But one of the first things that my mom and her siblings noticed, he had begun leaving the stove on. So they would go over there and, find the stove on and been on for 3 days in some cases. And so it's an interesting thing, but we saw it in our own family as just this, people putting themselves in danger and not even knowing it.
Yep.
Yep.
And that's kind of the second bullet point that we're talking about here. Like, what is the number one cause of care needs, right? And we can kind of split that as we did the presentation, 65 and above and 65 and below, right? The 65 and above, the trend has been towards, cognitive disorders like dementia or Alzheimer's disease. In the past, it wasn't as the number one cause over age 65, but in recent years, the claims for long-term care or long-term care needs have been driven over age 65 for cognitive disorders. Under age 65, what we've seen is the number one cause of care is the side effects of cancer treatments, right? That leave the patient too weak to care for themselves. So that would be the number one cause of needing care for those younger than age 65. That's kind of the general trend that we've seen over the last number of years.
Interesting. I didn't realize that. I would have thought it would have been an accident of some kind, but it's from the cancer. That makes sense. I've seen loved ones go through cancer treatment, and it's rough. It's very
Yep.
rough. Yeah.
Yep.
One other question, what about the median? We often have clients who want to know, well, how long does someone stay? What is the median length of stay? What are you seeing around that?
Yeah. So most of the numbers that are available out there are for when people go into a nursing home and how long they stay there, right? And that's kind of something we'll touch on as we go through this presentation. But in terms of from a nursing home, usually the rule of thumb is when somebody goes there and you're a male, unfortunately, the length of stay is usually around closer to 2 years. And then for females, it's closer to 3 years, right? That's the general rule of thumb. But what that doesn't take into consideration is for people that start to receive in their care in their homes, and maybe they're not receiving what we call skilled care, right? Someone who's licensed by the state or a facility that's licensed by the state, or people are receiving care by unskilled caregivers, friends, family, neighbors, right? So what's the length of care they've received from their home until they've had to move or progress up the food chain of care needs into some sort of assisted living or nursing home? So it depends, but right, we all are aware that care can happen anywhere.
Yeah, yeah, it absolutely can. Now, talking about ways to pay for that care, I said this last year when we did this webinar, but I used to use the term self-insured, and I
Yeah.
was corrected by a long-term care agent friend of mine who she said, Dana, I hate that term. It's not self-insured, it's self-funding. So walk us through here the different ways that you can plan to cover this potential cost.
Yeah, so I think a part of all of this is having the conversations, right? So saying if something happens and I need care, what are my options? So for those people who have not had the conversation yet, and for those people that maybe that have and made the decision to self-fund, right? Whether you know it or not, you may be self-funding already because you haven't had the conversation. But self-fund is essentially taking on the risk yourself. That you have your assets, you have the things you've accumulated over your life so that if something were to happen, that's where you're going to go to pay for that care, right? That's self-funding. And I think with that, it may be suitable for some people, it may not be. But in terms of where making the decision to self-fund or not, I think it's usually a risk question, right? Do you want to take on all the risk yourself? Or do you want to pass on some of the risk to a third party? And we'll get to some of the insurance-based solutions for that as we go down here. But I think really that's the question for most people is, do you want to self-fund or not? Right? You may be able to, but some people still make the decision not to. They'd like to pass on some of that risk to a third party. So when we're talking after self-funding, we talk about Medicaid. Usually for Medicaid, right? So just to make a differentiation, this is not Medicare. Medicare is health insurance, limited coverage for long-term care needs in a nursing home, co-pays, et cetera, as we talked about earlier. Medicaid is essentially when your care is paid for by the state. So what that means is that the assets that you've had are potentially depleted. If you're a single individual, you may be left with as little as $2,000 of countable assets. If you're married with a spouse, with the healthy spouse, it's called the community spouse. There are certain assets that are protected, a vehicle, a home, and certain income and asset levels. But for the most part, your assets have been spent down, and the state will come in and say they'll cover for your care. So kind of based on where our conversations are going today, talking about protection, this is not something that we want most people to go through, right? We're here to talk about strategies and solutions that can help keep you away from qualifying for Medicaid. But once again, for certain people, Medicaid may be the answer as well too. So, but once again, for that means your assets are at a level where you don't really have much anymore. And at that point in time, your care would be covered by the state. Now, for those who have evaluated self-funding and said, okay, well, I may want to self-fund or I do want to pass on some of the risk to the insurance company. That's where long-term care insurance comes into play, right? So I typically like to generalize long-term care insurance as someone's interested in purchasing a bucket of money from an insurance company that if they ever needed care, that's where they'll go first before they go to any of their assets they've accumulated. Within those buckets that you can buy from an insurance company, there's certain bells and whistles that can be added to it. You can have it for, any number of years that you're looking for, up to certain maximums. You can put some inflation protection on these products. Some of them have different features such as life insurance or cash value. But essentially think of it as a bucket of funds that you can go to. Now, most people are familiar with traditional long-term care insurance. That's typically the most cost-effective way to buy long-term care coverage, but it does come with some certain deficiencies, right? The biggest one that has kind of arisen over the last number of years is that when you buy a traditional long-term care policy, your premiums are not guaranteed. What that means is that if Stefan buys a policy in Connecticut today with a bunch of other people in Connecticut, the insurance company can come back in the future and say, hey, based on that policy we sold in Connecticut, we're losing money on it. Meaning people are going on claim earlier, they're going on claim longer, our investments are doing poorly, and they can petition the insurance commissioner and say, hey, we want to increase the cost of this coverage for this policy we issued in 2024 in Connecticut. Now, the insurance commissioner has the ability to say yes, no, or somewhere in between. Now, if you think about it, the insurance commissioner is working for the state, right? If the insurance companies go out of business, right, who picks up the cost of care for people that don't have any assets? It's the state. So you could argue that the insurance commissioners are inclined to allow these rate increases at a certain level to keep these insurance companies in business that offer traditional long-term care so that they don't have to pick up the cost of care. But once again, just to be putting it out there, traditional long-term care insurance, right, the premiums are not guaranteed. If you don't use the benefit for long-term care, there's no other benefits associated with it, right? It's purely long-term care coverage. And I think the
Yeah, and
last,
a question on that before we move on,
yeah,
because we've, in the last probably 5 to 10 years, have many clients that send us their premium option notices. Basically, the insurance company sends a note and says, your premium's going up, or you can, and they might give them choices,
yep,
of ways to reduce the benefits to maintain their premium at the same level. But I've also heard that when initially these policies were issued, the insurance company didn't have a lot of data to go on to understand what their claims experience might be like. And so there's some people that say we've probably been through the bulk of those premium increases, and the insurance companies may be pricing it more appropriately, also more expensively for the policies issued today, but those being issued today may see less premium increases in the future. What are your thoughts on that?
yeah. So I can give, there's obviously unfortunately a large body of evidence of the premium rate increases for people who've had the traditional long-term care insurance policies. So even with the rate increases, if you were to compare the current cost for an individual or couple that have already had a policy, been subject to the rate increases, versus them going to the market and buying a brand new one today, they're still in a more cost-effective solution for the one that they purchased in the past, even with the premium rate increases. So they're still in what I like to call a good deal. Not saying that they're happy with the premium rate increases, but typically we're able to show them that, listen, you're still in a better priced product than if you got rid of it and bought a brand new one today. So yes, I think to say that the pricing for a traditional long-term care policy is probably a little bit more accurate than in the past. I think that would be a safe thing to say. But a lot of times there's more options available today, right? And that's kind of the hybrid options there that provide a little
Yeah.
bit more value than what a traditional policy offers. And I'm excited about the long-term care market because for people that are interested in exploring their options, there are a lot more options today than there were in the past.
Yeah, talk a little bit about what we call the hybrid policies.
Yeah, absolutely. So we talked a little bit about the traditional, and now the hybrids came in to assuage some of the concerns that people had with the traditional long-term care market. Now we're combining long-term care and life insurance and potentially some annuity features here. But what this does is it allows us to guarantee the premiums in most instances. So regardless of what the future holds, the insurance company can't come back and ask for more premium dollars from the individual. The second thing is because it has other insurance benefits associated with it, that if you don't use the policy for long-term care, there's still a benefit, there's still value that gets provided to your family. So it's not a use it or lose it scenario. And the last thing that I like to add on these hybrids, the way they pay out their benefits, it's a lot different today than in the past. A traditional policy was a reimbursement style benefit. What that means is that you would incur the expense, show proof of payment, and then go to the insurance company and say, hey, these are long-term care expenses, and they would screen them. And usually the measuring stick is that the care is provided by a licensed health practitioner or facility, right? And they're licensed by the state to provide long-term care services. So if your services were not provided by a licensed facility or individual, the insurance company typically would not reimburse you for those. Fast forward to some of the products available today, they're what's called a cash indemnity model, right? So essentially what that means, that is once you qualify, right? You could ask my wife, I qualify now. The insurance company agrees through their diligence process. The insurance companies will then send you a check each month for the amount you're eligible to receive, right? This is a cash indemnity model. So they don't care how those funds are spent, right? They just care that you qualify at the beginning. So once you qualify and they're sending you these funds, you can use these funds for in-home care, adult daycare, assisted living, full-blown nursing care. But what I like about this is that if you're going to stay in your home, right, what we call home-based care, which most people would like to, everyone really these days wants to stay in their home for as long as possible. If you're receiving that care by unskilled caregivers, friends, family, neighbors, these policies allow you to stay in your home and maintain your independence and receive care in the environment that you choose. Because once again, the insurance company just verifies you qualify at the start, sends you your money, and then you can spend those funds as you see fit.
Yeah, I like that too because a lot of times at the point someone needs care, it's overwhelming trying to argue and fight with the insurance company, or they have family members trying to do it for them, trying to lobby on their behalf, what we call having an advocate. And it's
Yep.
just frustrating and it makes you just I've seen people just at their ends wit trying to deal with this. So the nice thing about having, just that cash pay is you don't have to deal with any of that at a point in time where you're already stressed.
Yeah, absolutely. And there's studies out there too that show that the people who are the advocates for the person who needs care or the person that's helping them, right? There's that level of stress that's added to them that unfortunately makes them more likely to need care themselves in the future. So by having a solution that's easy to use, easy to access, and from companies that are very reputable, right? It makes the whole process a lot easier and for everyone involved.
Yeah. Now, along those lines, because we were talking about making it easier on everyone involved, when we talk about this self-funding option, we run an analysis where we show people, an extended cost of a 5-year stay and whether they could afford it in their financial plan. But we also talk about the fact that even if you have the assets where you could pay for this, there's been a lot of research that shows if you have qualified coverage, you are more likely to get care and to get quality care. So there's that natural sense of like, oh, I want to protect my nest egg, and so I'm going to put off my care needs as long as possible. Whereas if you have coverage, you're much more likely to get the care that you actually need. Have you seen that also?
Yeah, because I think a lot of these, let's call it, we're more concerned about that nursing home care, right? So in-home care is something that's probably a little bit more manageable because of the lower expense associated with nursing homes. So for people that do have to go to the nursing homes, if they have a pool of money or the assets and the ability to pay for that higher level of care, they're going into the places that could be construed to be a little bit more higher quality, as opposed for those people that have lesser means or no insurance to pay for their care. Their options may be limited to going into facilities that the level of care may not be at a level that they've desired for either themselves or for those advocates for their loved ones. So,
Yep.
By having something in place, it does provide you the ability to receive a care or a higher quality of care in general.
Yep, it does. The last couple things to touch on, we have clients, of course, that want to buy into a continuing care community. Um, that's basically this concept that you're going to move into a place and it's going to provide the different levels of care as you may need them. Talk a little bit about some of the risks, pros, cons that people need to watch out for when considering that.
Yeah, I mean, the overall concept of continuing care communities, it's fairly sound. I think that plays on people's desires to want to be able to age in place, meaning that if something were to happen, that they're not having to go to another location, they're not have to move to a nursing home, because these continuing care communities have the ability for people to have independent living. They have the activities for the people to engage in with other individuals and families and couples who live there. And also, as you move up the food chain, as I keep kind of mentioning, it has the assisted living and it has the full-blown nursing care available there. So once again, it does provide convenience for individuals who say, if we're going to move here, typically 55 plus, where they can stay in this one area and receive any of the care they need. Absolutely, it can be a very big convenience feature. But I think the downside to some of these places is obviously the cost associated with it, right? You may be staying at a place and paying for things that you may or may not ever need. And for that convenience, there's a cost associated with that as well, too. So I think it all comes down to having that discussion to see what makes the most sense. But they can be a very good solution for some individuals who are willing to kind of endure, or I guess, may have that extra cost, and for some individuals who prefer to maintain a little bit more independence, right, then maybe not so much. But once again, it's another option that's out there.
Yeah, and we've had people even have their attorneys review the continuing care community agreements. If there's some communities that require a large lump sum up front. So what happens if that care community goes bankrupt is a consideration. There's others where people just didn't realize that, yes, the levels of care were available, but for an additional cost. So they would get billed for the additional care as they needed and hadn't factored that in. So those are some things that we have people watch out for. And then we talk about pooling resources. I mean, you mentioned several times, care from family, non-skilled care, your community member, which I always call it the Golden Girls plan. That was kind of in my mind, like, oh, okay, that'd be great one day. Me and my girlfriends from long ago are going to get this apartment together. And so, of course, there could be some fun options like that. But, realistically, if you have someone who's like, well, my family will take care of me, what are your thoughts on that?
Yeah, I think it goes back to kind of what I said about who ends up being a primary caregiver to anybody who may need care, right? So the impact to that person's health of providing care to someone in need can be detrimental in the future. So I don't typically recommend that the community-based care or the family care is the primary option. And that's why some of these insured-based solutions make a lot of sense, or once again, self-funding, where at least you have a plan for when you need care so that you can take that burden off family members. Now, can the pooled resources work? Absolutely. In actuality, typically you don't see that put into effect as much. But there's the old saying, right? Too many cooks in the kitchen is a bad thing. So it kind of remains to be seen. But I tend to encourage people to explore other options than pooling resources with family or friends.
Yep. And we're almost wrapped up for everyone. I know we're running long, but it's just a lot of great and important information. So the last thing on long-term care, and then we'll open it up here for Q&A shortly, is, we've heard about these states implementing a long-term care tax.
Yep.
What is this?
Yeah, so the one state out there that did implement a tax a number of years ago was Washington. So for individuals that did not have a qualified long-term care solution in place, whether that was a big policy that provided lots of benefits or a small policy that provided minimal benefits, that made those individuals exempt from that employer tax. But for those that did not have some sort of qualified solution in place, they were subject to a 0.58% tax on their income that would be used to fund the long-term care coffers for the state of Washington. Now, it's interesting that there's some legislation out there that's being passed through in Washington to repeal this act or allow people to opt out. So as soon as it's been implemented for a few years, there's already some legislation out there where they're talking about being able to put something in place for people being able to opt out from this. And then the general consensus is, if that's the case and people start opting out, it's going to bankrupt the program. So once again,
Yep.
it's out there, and there's a couple of other states that are on the list where they're a little bit further along from the discussions with this. I would offer that in the election year, there's nothing that's pending that to be implemented. But of those states after Washington, California, Minnesota, and New York, they're all kind of further along in those discussions. But I don't think by any means we're at any point where they're anytime soon when any long-term care or qualified long-term care requirement would be put in place. But those discussions are out there and they're happening. But as of today, I don't think there's anything impending, so to speak, from a legislative standpoint.
So as of now, no Social Security-like program that we can just rely on and, move on our merry ways.
No,
Squarely falls on us. Yep.
yeah, yeah. No, now I know there was a couple. So part of the election cycle, right? The presidential candidates tend to make some statements out there, whether they hold true or not. But I know there was a recent statement by Kamala Harris where she was talking about using Medicare to pay for in-home care. And that was a statement that she did put out there. How that would work in actuality, I think remains to be seen. But that was kind of some bluster out there as well too. So it's talked
There's
about, but we'll see.
always a lot of bluster during the election years.
Imagine that. Imagine that.
Imagine that. Well, wrapping up, we encourage everyone to have a plan, create a timeline of your expenses, what it's going to look like as you transition off of your employer coverage. Work with an agent that understands your healthcare.gov and Medicare options. Talk to your benefits department, or as we discussed, call your insurance company directly to find out if they're offering creditable coverage. Each year, evaluate your options during open enrollment. Consider a plan and evaluate your options for covering long-term care needs in the future. There is Medicare open enrollment happening now, as well as healthcare.gov open enrollment. Mike, one thing we didn't touch on, and here we're going to open it up to Q&A, but there's a big change to Medicare this year. I believe they've described it as a $2,000 kind of cap on your out-of-pocket drug costs, but there's some caveats to that. Some drugs may not be covered. Plans that covered drugs last year may not cover the same drugs this year. So I've heard if there was ever a year where you needed to evaluate options, and once you're on Medicare, we didn't touch on this, but you should really evaluate your plan every year. Anything you want to add on to that?
No, that's really the gist of it there is it's great. It's a long overdue cap of $2,000 that's never been capped since the program started in 2006 with Medicare drug coverage. Very helpful to have, but as that kind of got shuffled around in a lot of the insurance designs, some drugs left formularies, and you just want to make sure that it's covered, because if it's not on a formulary, meaning your plan doesn't cover it, it is not subject to that $2,000 cap, and you could incur some higher expenses that may be able to be avoided. So yeah, definitely make sure you get everything reviewed this year.